Laura Hodges, MEPS US steel market analyst. Welcome back to the Market in Minutes podcast. It's good to see you.
Good to see you as well.
That means only one thing. We are talking about the United States in Market in Minutes this month, and there really is never a dull moment, is there? I mean, things are happening all the time, but I think initially, at least, we should probably focus on the developments with the USMCA. This all happened following June's publication of the International Steel Report. The US government fell short of renewing the terms of the USMCA. What does this mean for the North American steel market, though, at the moment?
Hi, Tom. Great question, and thanks for having me today. You are correct. As of July 1st, the U.S. did decide not to extend the USMCA, the United States, Mexico, Canada agreement that has defined the market for this and previous kind of iterations of it for more than 30 years. They decided not to extend the agreement for the next 16 years. That's really what the critical point was on July 1. But effectively, the agreement terms are status quo at this point. What it does do is that it triggers this point where they need annual reviews for the next 10 years or until they renegotiate the terms of the agreement, which is really what the United States is looking for. But we do, regardless of whether it's status quo or they're in negotiations, we do believe that this does have implications for North American steel markets right now and in the near term, medium term, longer term. So near term, it's simple to say this does increase the leverage that the United States has going into the upcoming negotiations on the fate of USMCA. Keep in mind that all countries benefit from this agreement. Again, it's been, before this NAFTA, an agreement that's been in place for more than 30 years. And you can read more. We did do a brief article out on our website about some of the benefits and implications for this. But Mexico and Canada are a bit more. Bottom line from the benefits is that the Mexico and Canada are a bit more dependent on this agreement than the United States. And ultimately, the leverage was already with the United States, but this even increases it. It also increases the likelihood that Section 232 tariffs will not be reduced within these. There's been a big negotiating factor, or at least a big talking point for both Canada and Mexico, is that they hope to reduce some of the tariffs, not just with steel, but aluminum and automotive, and for Canada, even lumber. But this does kind of reduce the likelihood that happens. But the biggest thing, and what everyone's really talking about, at least in the near term, given the uncertainty that this decision does bring to the market, investment may be reduced, particularly in Mexico. MEPS research partners in Mexico have already started to, express some concern that maybe even some of the current projects in place investment projects, the construction projects to build new, manufacturing infrastructure facilities may even be delayed or worse, canceled because of some of the uncertainty. Of course, this will all depend on how long these negotiations occur between the United States, Mexico, and Canada. But nevertheless, this uncertainty that it brings, and we've all heard the word uncertainty over the last year and a half, it does it does change demand patterns. It does change, decision-making process. So that's probably the biggest thing. The near-term dynamics, more importantly to what we care about here at MEPS, is that in the United States, all of these are supportive still of near-term pricing for steel. And for Mexico and Canada, depending on how long, these negotiations sort of stream on, you could, it may have more of a longer term impact, but it could be more bearish depending on one, the outcome of these negotiations, as well as how long this uncertainty kind of lingers on, just due to some of the impacts it'll make on their domestic demand for steel.
You mentioned there that the negotiations are ongoing. Am I right in thinking that there was some suggestion that the US might demand some investment from particularly Mexico in sort of US steel production? So investment might be incoming. Is that a prospect?
I don't know if this is what you were thinking of, but there was an announcement maybe last month or two that Mexico and Canada could get reduced tariffs should they invest in the United States. So, if they expand or even build new facilities in the United States, that they would be granted lower tariffs for steel and aluminum. The main thing that you might also be thinking of is just the rules of origin. That's a big thing for NAFTA and now USMCA, is how much North American content can be accounted for to receive the preferential tariff treatment of goods coming into really all countries within the agreement. And I think there is some reports that the United States is looking to increase the rules of origin and maybe even place higher emphasis or higher share attributed to U.S. production as part of it. So,
all part of the leverage it's got as that big steel consuming market, of course.
yes.
We've touched on the influence there of the trade defences, but could you share a little bit more insight, I guess drawing from the International Steel report recently, into the supply and demand situation in the US right now? How's that influencing prices in particular?
It's influencing, pricing quite a bit, particularly on the supply side. Supply still remains tight. We continue to hear from our research partners that spot availability, particularly on the hot rolled and cold and coil side of the market, is very limited. So that has been very supportive of pricing. Not just last month, but over the prior, several months, since really the beginning of the year. Imports, interestingly enough, I say supply is tight, but, imports are still continuing to inch higher. This is important because, from a domestic standpoint, we're already sitting at 80% utilization rates and have been for the last several, few months. So looking at imports, that's where we're going to get an expanded supply of steel. So imports are increasing, attracted by our higher pricing. And so for most products, we are still sitting below year-over-year levels for imports. I will say one interesting development, if you're looking at the preliminary import data for June, we just now got out of June, but so that data is still, preliminary. Hot rolled and cold rolled imports increased, which increased fairly strongly. We have hot rolled imports now over, again, if this preliminary data, and it's been tracking pretty well, was over 100,000 metric tons last month. So that's a good increase, and now year over year it's increasing. So it's hot rolled and cold rolled are now showing positive year over year developments last month. And this has been something we've been seeing on the long side for a few products for the last several months, namely rebar and structural shapes or beams. So that I thought was an interesting development looking at the data more recently as we've kind of closed that last month. On the demand side, I would say it's still fairly uneven. Not bad, but depending on where you sit, though, not great either. So our research partners continue to kind of point to data centers, related kind of industries such as power generation. You need a lot of power to to run those data centers. And then infrastructure has been another one that's been pointing as sort of the brighter stars of demand for steel right now. And you can kind of see that in the data. Construction spending on data centers in May grew over 20% year over year. And an amazing fact, because I always have to look at the data center data because, it is an amazing growth path that they've been on. Just over the last 2 years, so since 2024, that spending has gone from annualized rates of 30 billion to almost 60 billion right now. So that's in a pretty extraordinary kind of growth path. But you don't have to look very far, though, to see that from a wider lens, construction spending is not doing great. We've had 10 months now of declining year-over-year growth rate in overall construction spending in the United States, and that has really been led by non-residential construction. And so I'm watching this very closely because there's two reasons to be even a little bit more concerned about the wider construction market here in the United States. One, that construction number is nominal, meaning that it doesn't strip out inflation, and we know that inflation has been fairly strong here, so you could have on a real basis even kind of a steeper decline. And also, it's very wrapped up. The growth that we have seen has been very wrapped up in data centers and related spend, non-residential. And you still, even with that strength of those markets, you've seen a declining path for non-residential. So, and then finally, on the manufacturing side, you do have kind of a similar story. It's fairly uneven, but overall, you see ISM PMIs are now up they've been up since January, and we just closed June's figures. So 6 months now, we've had a reading above 50, which is aligned with expanding market. But under the lid, again, you are starting, if you read through the comments and you look at the underlying data, a lot of that strength is tied to data centers. So the bottom line is, I hate to be, not a great viewpoint on this, but, data centers and tariffs are really keeping our pricing kind of strong at this point. If one of those two areas were really starting to change, the pricing kind of environment could be somewhat different.
Okay, well, finally, it's probably worth us taking a moment to look at MEPS outlook for US steel prices in the months ahead. What are the expectations given the market's current trends?
Despite what I said, supply has been tight, demand has been fairly uneven, and along with that, our outlook really hasn't changed that much over the last few months. We are expecting steel prices to stabilize over these summer months here in the United States and then decline gently. And I think that gently is the key word. We are expecting a gentle decline over the remaining parts, so through the fall and winter months for steel prices, at least through the end of the year. I think there's really 4 things to kind of highlight that are supporting these. We have started to see the rate of increase in steel prices slow. Like last month for hot rolled, it was under 1% month over month. So, and before, it's just kind of gone from like 6%, 5%, 4, 3, 2, 1, so we're just starting to see that rate of decline or increase slow. We're now not expecting any rate cuts for interest rates this year due to higher inflation we've seen. Pretty much there's not many people out there that are expecting a rate cut this year. Maybe a rate hike, but most likely it's going to be relatively stable. But this does impact the cost equation for new construction projects or construction projects themselves, particularly given the higher inflation for the construction materials themselves. stable rates, but at a higher level than I think most people want them, plus higher inflation for the goods that you need to build these projects, it's sort of not favoring huge amount of construction projects moving forward. We've already had 8 months of rising prices for hot rolled coil. Keep in mind that the last big boom that we've had or strong, increase that we had in steel prices in during COVID, effectively 2021 time period, lasted only 13 months. So we are starting to get to. I mean, there are typically kind of boom and declines periods in steel markets here in the United States. And also, as I mentioned earlier, imports, I think, will help keep a lid on prices. So I want to go back to the gentle decline. Keep in mind, we're not expecting a dramatic decline in prices. A stabilization this summer, a gentle decline. Hot rolled coil, we're expecting to move back towards $1,000 per short ton. But I think that is enough to help keep imports under control, and given the levels of demand that we'll have here in the United States in the second half of the year. So that's really where we stand. Not much change in our outlook, but at least it's offering our listeners a little bit more flavor to why we're expecting what we're expecting right now.
Well, there's a little bit of stability, and given the policy changes that are going on, I imagine that a lot of people will welcome that relative state of predictability. We shall see how
there are a lot of risks. We're not getting into those right now, but as check out our website or our publications, our reviews, and we certainly highlight several of those risks in those.
Absolutely. Laura, thanks for that great overview of the market as it currently stands. As you rightly remind people, the best place to keep up to date with the current steel prices, market commentary, and the 12-month forecast that we provide is the International Steel Report. So if you don't already subscribe to those, please do. Laura, thanks ever so much for joining me. That's been great. Another Marketing Minutes podcast.
Thank you.
Thanks a lot. Bye.